What's going on, folks? Happy Friday, October 3rd, 2025. My name is Hamilton. Joining us today, co-host Randy. What's up, Randy?
Hey, how's it going, guys?
For those of you that don't know who Randy is one of our analysts on the team. He frequently joins me over on Twitter Spaces, which we run once per week as well. We love doing those. They're off-the-cuff stuff. We talk half hour to an hour, things that matter in the market, throughout the week. We answer questions, etc. So for those of you that haven't been able to make those Twitter Spaces, I encourage you to do so. But for today, we're going to focus on the entirety of the week, right? The weekly roundup here. We're going to be focused on the biggest themes of the week, the biggest winners of the week, what we're expecting really as the beginning of the new quarter starts, what we're expecting over the next quarter. And as a matter of fact, I kind of want to open up with that in mind. Randy just posted a beautiful piece of data over on Twitter. If you're not following him, by the way, follow him at ITM Randy over on, I say Twitter, but X, right? Randy, why don't you go ahead and let us know here, the graphics up on the screen. Why don't you let us know what we're looking at here? It says strong Q3s lead to stronger Q4s.
Yep. So we all are familiar with the common seasonality issues that we were supposed to hit. In fact, I was really aware of that, and I was expecting that this year. But we actually saw the opposite. And so I went through history all the way back to the 1950s, and I looked for years where the third quarter was stronger than average, and not by like 1 or 2%. I'm talking a massive outperformance in the third quarter. So I went back and found a few instances where the third quarter brought in at least 7% above average. Now, average was about, I think it was like 2 or 3% during those 3 months. So a 7% outperformance is notable. And I went through and found the quarters where that happened, and then I looked immediately at, okay, if this is what happened during the weakest part of the month, then what happens during the best part of, if this happens during the weakest part of the year, excuse me, what happens during one of the best parts of the year? So I went and looked at the next quarter's performance, and what I found was that the stronger than average Q3 leads to a stronger than average Q4. So in that chart, I've got all years going back to 1950, and then I've got just the years where you had a strong Q3. And in every instance where the strong Q3, or not in every instance, but the average and the median is higher for the next quarter if the third quarter produces a really strong return. So this is just really something that we say all the time in TTI, with strength begets strength. And I saw this chart. I saw a similar chart posted with each. He was just looking at the next month. I wanted to take a little bit of a longer term vision of that and see what happens in the next quarter. And actually, I didn't know this, but when you have a really strong Q3, every time you've had a very strong, at least 7% above average Q3, the next quarter was positive. Now, sometimes those numbers can be really low, like in 1984 we saw 0.7%, but that's not the average, and that's certainly not the median. Average and median are higher than what you would normally see in any given year.
Yeah, it
So
looks like it's
that
about
just
double.
is, yeah, yeah. So
I
that
mean,
just gives way to a great Q4 rally and a good Q4 setup.
inside of TTL, we've talked about this. Seasonality matters a lot, right? We focus on seasonality in terms of it builds expectations, defines the environment that we're in. We knew, particularly August and September seasonally, were weaker months. August tends to be break even or slightly down, and September tends to be just straight down. Both of those months not only were not weak, they very much were strong. So if you sold in May and went away, you missed out on an incredible summer to own some of the best stocks in the market. Having said that, what matters more is when seasonality doesn't play along, right? So if you're expecting a weak portion of the market based off data going back to the 50s and it wasn't weak, what does that infer moving forward? Could we realistically expect that the next corridor of data, which in this case would be Q4, would it be stronger, and the data does support that? So yeah, I mean, it makes sense, right? As you said, strength begins strength. And I always go back to the point where trends tend to persist a hell of a lot longer than most people expect. There's a graveyard filled with people that are trying to call tops in markets and different asset classes, et cetera. Eventually someone's going to be right, but think about the 95% that also called that top that weren't right. I think go back to 2008, Michael Burry and a handful of people that made billions of dollars off of the housing market short. Think of how many people had the same idea as Burry, but were early and were not liquid enough to be able to see it through. I'm sure there were a lot of people had the same idea as Burry. It's the same thing here, right? You want to try to call a top, you're probably going to get rolled over, and the data tends to support that. So yeah, we're geared up for a better than average Q4. And I think one of the main things here that we're focused on in particular, something we were talking about earlier today in the Discord, is I was just seeing it earlier today. People are kind of talking about, you might want to risk off a little bit with beta. You might want to raise a little bit more cash. And we're actually the exact opposite. We think now is the time to press the gas pedal down into Q4 and not miss what's about to happen next. There's a couple different reasons why. One of the biggest things that we like to do inside of TTI is we like to look at intermarket analysis, where we're comparing different areas of the market. And when we're utilizing, for example, a high beta against lower volatility ratio chart, essentially what we're looking at is the high beta trades or the high beta stocks in the market. How are they performing against the lower volatility? And I want to take it one step further and think about, what does that mean for risk when we're thinking about high beta and lower volatility? If higher beta is performing well, is it reasonable to expect that we're in a risk-on environment? Well, yeah, I think so. That makes sense. Financial institutions, asset managers want to own higher beta stocks when markets are ripping higher. And conversely, when lower volatility stocks are outperforming, you would expect those to be outperforming. If assuming the market's going to fall. If financial institutions are positioning themselves away from risk, meaning that they're expecting the market to pull back, maybe they'll pile into some lower volatility stocks, go for the dividends, etc., hunker down in things that are going to die less than the index, which in this case is the S&P 500. So when we're looking at this ratio, we're asking ourselves, what are the financial institutions? What are the asset managers, which in aggregate drive primary trend? It's not retail. It's not your boy on Twitter that's telling you that the trends are up. It's because he says so. It's what are the big banks thinking? What are the big asset managers, the trillions in liquidity that they control in aggregate? What are they thinking? And so when we go and we look at this, throw it on the weekly, we get a very clear picture here. We're at all-time highs in higher beta against lower volatility. We're at all-time highs, meaning, again, is this the time, realistically, to be pushing the brakes? Or should you be leaning into this strength? Should you be leaning into the trends here that are emerging into Q4, which there are a lot of trends that are emerging into Q4. We'll go through those in a second, but I want to yield back really quick. What do you think about this high beta versus lower volatility? And Randy, you do a lot of intermarket analysis. What do you think about other intermarket relationships that are confirming the risk on mentality?
Yep, such an important point with this intermarket analysis work. The whole reason we do this work is to figure out what the market is rewarding. Are they rewarding risk-on areas such as high beta, such as consumer discretionary, such as growth, or are they more so rewarding lower areas? This is value, lower volatility, and other defensive areas. And one of the reasons why we have such a high importance to these ratios is because when they actually do well, the broader market does well. So it does more than just signal what regime we're in, but it also helps allude to the market direction. There's a study I did last week or maybe a couple weeks ago that looked at the equal weight RSPD versus RSPS ratio, and when that ratio is trending higher, very simple measure, above or below its 200-day moving average, the S&P 500 performance, I don't know if it's exactly double, but I think it's somewhere around 2x than if the ratio was trending lower. So it does give way to what the overall market environment is like, but it also helps just with market performance, plain market performance. And when you see these ratios breaking out of these huge bases, I mean, that's a signal. That's a huge signal. It means that investors are aggressively getting into these risk-on areas. Now, you can say, okay, maybe we're overstretched, maybe we're not, but whenever you're in good, solid trends and momentum is thrusting you higher, don't you kind of want those ratios to be overbought? Isn't that a sign of massive buyers coming in on those
I mean, it's momentum.
risk-on areas?
That's what it's
Exactly,
momentum.
exactly. So these are all important, and one that I can't just get away from is the ARC to S&P 500 ratio. That ratio is like burning through 52-week highs. If you look at it on like a rate of change basis, it has extremely shot up in like the last 100 days. We haven't seen anything like this since the post-COVID stimulus rally. And ARK is an innovation fund that's got a whole bunch of speculative, innovative, disruptive technology. I can imagine their balance sheets are not the best, but whenever you see this ratio going higher, it's telling you that people do not care. They just want to buy the most speculative tech out there. So it really matters when you see this thing breaking out of a base and pushing into 52-week highs.
It's a massive stage 1 base into a stage 2 breakout. If you were Mr. William O'Neill, you would own ARK and the components within ARK. This is why when people are on Twitter that are screaming raise cash, get out of high beta stuff, blah, 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 it's hard to take them seriously. And we talk about this a lot inside of TTI. When you go out and you consume content, I'm not saying don't consume content from your favorite creators or other opinions. I think it's important. Understand where other people are coming from. There's a lot of value to be found in that. But I want to stress that you need to be able to go and actually verify their claims. So I'll give you a great example. If somebody says, watch out, high beta probably is going to get hit or whatever, and that's the theme this morning that we were talking about in TTI. There's people out there saying, coming into Q4, be careful. Banks are starting to show some divergences. High beta tends to follow. Then you go and you look at like an ARK breaking out to 52-week highs. We're clearly in a stage 2 uptrend. We've just come out of a consolidation fractal in the middle of September. So we're only like 3 weeks into this new uptrend in ARK after a consolidation phase through the middle of the summer. And it's like, is this really the time to pause? And once again, opinions are fine, but I will tell you, a lot of people are very, very emotional and irrational with their analysis. So as always, go and look at the charts yourself. If somebody says market breadth sucks, you have the tools to go and figure that out. Does it suck? And I'll give you a hint, it doesn't suck. Okay, one that I want to point out, because you brought up a couple other ones, is this XLK against SPY. We've been on this thing since May. This is arguably the most important ratio in the entire market. I think it's the most important chart in the entire market. This particular ratio is showing it. What am I doing here? Is showing us the entire tech sector's performance against the S&P 500. And there's going to be people out there that say this is a bubble. Valuations are stretched. You better be careful. But when it pops, but they've been saying that for 3 fucking years. So eventually they're probably going to be right. They've been wrong for the last 3 years. My question is, how much longer are they going to be wrong? Could it be another 3 years? I have no idea, but trends are clearly up, and we're clearly at an inflection point right now. It's been a couple of years in the making. We were up here in June of 2024 before tech hit that bear market from June of 2024 through April of 2025, nearly a year-long tech bear market, both by time and by price, with tech sector selling off like 30% at its April 7th low, is now leading the market higher off of April 7th and breaking out against its 2000 highs. This is the most important ratio because it's essentially screaming to you that tech is not only in a leadership role, but it's going to start leaving everything in the fucking dust moving forward. And before anybody comes out and says, this is a lagging indicator, for example, or this is just essentially confirming what we already know, which is tech is leading. Look at the semiconductor ratio the last time this happened. It's the exact same idea. We broke above the 2000 highs. This case was May of 2023 was when we broke out. And by the time this ratio peaked over a year later, folks, 12 months later, semiconductors had outperformed the broader market by 50%. 50%. For those of you that were trading in 2023, the area to own was semis, and in particular NVIDIA, right? These relationships and these breakouts matter because they are inflection points. They are typically when rocket fuel gets poured onto existing trends. So when we look at XLK against SPY breaking out, this is a ratio. What is it telling us? Financial institutions, professional money managers, etc., the guys that control primary trend are telling us, they're signaling to us to stay in tech. As a matter of fact, probably buy more tech. And as always, I want to point out, these relative charts are great at, as Randy told us, kind of peeling back people's opinions of the markets, right? What are financial institutions and professional money managers, how do they feel about tech right now? Well, obviously they'd rather own tech than the broader market, but we have to go and match that with an absolute chart as well. It's not just on a relative basis. What is the absolute chart telling us? And folks, I don't know how much clearer it can get. This is an all-time high breakout. after a 2-week pause at the 2.618 fib extension, could we see a 345 XLK within the next 6 to 12 months? Yeah, I think we absolutely could. Please keep in mind, again, this is not the most popular call on Twitter, and I'm going to continue to say it until a year or two from now. It's very popular and obvious in hindsight. This was a bear market in tech through time and price. New bull market in tech, 345 is the PT. Think about which areas of the market are going to lead. I know I might sound crazy, Randy. I might sound crazy, but does it? Could it be right? Could I be onto something?
I would say no if it wasn't for the massive amount of strength that we've seen just in and out. And the fact that we pivoted so hard off of that April 8th low is insane. I mean, if you look at it on a monthly chart, it's just straight up. It's literally
I'm going to
just
pull
straight
it
up.
up. We're going to go back to the April 7th low to today. And we're going to look at the performance of sectors. Performance of sectors going back to, whoops, that's 2020. 2025, April 7th. It's been tech and everything else. I mean, literally, look, 57% in tech. Next closest sector is comms, up 34%. And then you have the goddamn S&P 500. Meaning, there's been 2 sectors since April 7th that have outperformed the goddamn index. So if you've been long materials, if you've been long energy, you've been long real estate, you've been long utilities, with size, you've underperformed the index. That's it.
Yeah. Yep. If we have a nice year next year, I mean, I definitely think we can see it, and that's just at a sector level. That's not looking at the individual stocks that if they have relative strength, which is a big thing of what we look at inside of TTI, those can go so much further than 20% in a year, especially if we apply leverage strategies like we do. Those could have insane amounts of gains to
Here we
them.
go. I mean,
So
here I have it up right now.
that's
XLK, 75 holdings, year-to-date performance, ranked by return. Here's your top 10, folks. For those of you in TTI, we've owned half the list this year. There's a reason. We own relative strength. We own the strongest components in the leading areas of the market. You want to outperform the market, you got to own the goddamn things outperforming the market. That's the key to everything that we do inside of TTI. And there's nothing telling us to slow down. I think that's the craziest part, is I would have expected something telling us to slow down. And there's nothing. As a matter of fact, I'm not going to go into the sentiment, data, and everything else that we normally go into, but there's still an incredible amount of bearish sentiment out there, meaning that sentiment is not a detriment to this uptrend. It's not like everybody's aping in. It's not like there's max bullishness going on right now that leveraged everything is it's not true. We just looked at this on Wednesday. For those of you in TTI, our monthly market blueprint, we looked at the AAII investor survey. We looked at the NAAIM asset manager survey, right? These guys are under allocated to a market that is ripping into new all-time highs. And retail, while it is slightly improving, less bearishness, more neutrality at least, we're nowhere near extreme bullishness, which to us means there's a bigger runway higher. Randy, let's talk really quick about crypto. We're bullish crypto Q4. We've talked about this yesterday.
Yep.
Why don't you give me 30 seconds to a minute on why we're bullish Bitcoin in the crypto market in general through Q4?
Sure. Okay. Here are the few reasons. First, crypto is in a long-term uptrend. We look at anything that's in long-term uptrends, and we like things in long-term uptrends. Second reason is the seasonality aspect of Q4 with crypto. A lot of the gains from crypto come in that last quarter of the year. Third reason is that we're seeing, I mean, Bitcoin actually right now, I have it pulled up, is actually near all-time highs. I have not seen
There's not many
much
people
about this.
talking about it.
Yeah, I have not seen much of that, actually. I'm actually kind of surprised. But we're trading at all-time highs with Bitcoin, near all-time highs with Bitcoin, near all-time highs with Ethereum. And people are still wanting to short or at least not be involved in this thing. So we have the combination of 3 factors. Seasonality tailwinds. We have long-term uptrend and positive momentum. And third, there's not a lot of eyes on this right now.
We have 2 days
There's
for a
just
weekly
not.
close on Bitcoin. This will be the highest weekly close of all time. For those of you that need help, throw a line chart on. Get those wicks out of there. Should we close today, which I'm not saying we will, but should we, that's an all-time high in Bitcoin on the weekly. There's nobody talking about it. At least, I shouldn't say there's nobody. There are people out there talking about this. there's not enough people talking about this to back you up to sit here and say we're frothy. As a matter of fact, it's the exact opposite, in my opinion. We're nowhere near like max froth whatsoever.
I agree. Yeah, I think I'm not a crypto maxist, or I don't like look at this and involve myself 24/7. But those pumps that we've seen, I don't think we've even seen the massive pump of this cycle,
Yeah,
to
I
be
don't think
honest.
so.
I really don't think we have. So, it's just basic. It's just going down to risk reward. How much are you willing to risk for 3, 4, 5, 6x return, right? And I think we can definitely see that in crypto, especially in Q4.
I think the key here is if you get out of the Bitcoin chart and you just look at something as simple as a total crypto market cap, and you look at not only market structure but trend, we're clearly going higher. I mean, in my mind, one thing that I was seeing earlier this week on Twitter, FinTwit, was that a great way to get out of your own mind, right? Strip some bias and focus exclusively on trend is to remove the goddamn candlesticks from your charts. I mean, if you're looking at the chart right now, this is just your simple 200-day moving average. And if you just trade the slope of the 200-day moving average, and this is a rhetorical question, could you be profitable? And a non-rhetorical question, would you be more profitable than you currently are? If you're not constantly worried about chart patterns, individual candlesticks, all of the shit that most people probably shouldn't be focused on, would you be more profitable? When you look at something like a total crypto market cap, which is essentially just a liquidity filter. I mean, we're looking at liquidity. Is it coming into the market or coming out of the market? Is the funny line sloped up or is it sloped down? It's sloped up. Liquidity is continuing to enter the market in the crypto space. We're back up and over 4 trillion. We're at 4.1 trillion. Is it reasonable to expect that if liquidity continues to come into the market, that crypto assets are going to continue to go up? Yes, I think it's absolutely reasonable. Big one that we talked about yesterday with Josh was the total 3. You take out Bitcoin, you take out Ethereum, we get this breakout above 1.14, which I think is happening. There's a very strong correlation between this chart and the Russell 2000, which, by the way, we are getting the breakout into all-time highs. So congratulations to those of you that are holding either the Russell 2K trade or some small cap exposure. This is 3 years in the making. Finally getting the move here in the R2K. I think the total crypto market cap without Bitcoin and Ethereum is next. These things track each other. So very bullish crypto Q4, very bullish risk assets in general. I think it's important. Not only are we bullish the market, but in particular risk assets, higher beta assets, tech, consumer discretionary, communications, gold, silver, still very bullish for both of those. Still very bullish for crypto assets. I think it's, as a matter of fact, as we started this, I don't think people are bullish enough. I think the bigger problem here is playing this too safe. I really do, because there's not many opportunities in the market, at least the way that it's shaping up right now. The market moves in spurts. We all know that, right? Everybody understands that. You get these 6 to 8 week moves, and then you get nothing, and then consolidation and a sell-off, and then big moves. It's not just a sustainable parabolic move to the upside. You got to be in position to capture these spurts, and it does look like this Q4 is going to have one of those spurts. Randy, it's been 25 minutes. Do you have anything you want to add to this conversation before we call it?
I think look, I think we've got such a great setup going into year end. If you're concerned or worried about, every local swing high and swing low and you're waiting for the perfect entry, you're not going to get it. And there's potentially a case where you just miss the entire move in general because you never got in. So look, I would say, if we see some sort of pullback, great. Add in. That's certainly what I'm going to be doing. This is not financial advice, but I'm certainly going to add into my positions if we do see some sort of pullback in the broader index, just because we have such a strong case for a strong Q4. But at the same time, I'm not waiting for that. I'm going ahead and entering into these positions that I have conviction in. So I wouldn't be concerned with the minor wiggles of the market. Just put yourself in a trend and just ride it.
Couldn't agree more. I'm going to finish the TTI Weekly Roundup with this intermarket analysis chart that's on the screen via Koifin. Look at your assets throughout the market and look at typically the assets that are highly correlated to risk on environments. Bitcoin, You have your Qs, your equally weighted Qs. By the way, breadth looks fine. There's some slight divergences, but looks fine. R2K, Russell 2000. Look at your risk assets. Look at all of them in as a whole on the weekly. What do they look like over the last three months? What do they look like over the last 6 months? I see solid green in nearly every single risk asset and nearly every single asset in general. Solid green across 1 week, 3 months, 6 months. If you need help identifying trend, you can create this watch list yourself. Steal it from me. I don't care. This will keep you aligned more than 99% of the shit you read on Twitter. Trends are up. The supporting evidence suggests a strong Q4. You are your worst enemy here, folks. Own the leading areas of the market with conviction and be unapologetic about it. All right? Randy, it's been great. I love doing these with you. I appreciate you. We'll
Yes,
be back.
sir, likewise.
We'll be back next Friday for our next TTI Weekly Roundup. For those of you in TTI, we'll post this right now over on the market research site and we'll have a conversation about it. For those of you looking to join, the link is in the description. Feel free or reach out via the newsletter. My name is Hamilton.